Maya was born in 1988. By the time she got her first real job, the economy had just destroyed itself. Her entry-level offer had been rescinded, and her student loan balance was $34,000, larger than her starting annual salary. She graduated in May 2010, 14 months after the stock market had lost 57% of its value from peak to trough. James was born in 1974. By the time he got his first real job, the internet boom was accelerating, his company was expanding, and the unwritten social contract of the industry was still intact. Show up, perform, stay loyal, move up. He bought his first house in 2001 at a price-to-income ratio of 3.2. He has worked for the same employer for 21 years. They talk about financial responsibility the same way. Save for retirement. Build equity. Don't take unnecessary risks. But the words do not describe the same world. And that gap between the economic conditions Maya built her financial habits inside and the ones James used to build his is the source of almost every workplace conversation about why millennials are so different with money that has ever happened in a conference room. This video is not about who is right. It's about understanding where Maya's habits came from and which parts of that thinking are actually worth keeping. Let's start with what shaped everything else. The crash. Maya graduated into the worst job market for new entrants since the Great Depression. The recession didn't just delay her start, it permanently altered the foundation of every financial instinct she would build for the next 15 years. Here's the thing. The 2008 financial crisis was not just an economic event for millennials. It was a financial education, delivered in real time, at exactly the age when financial instincts are formed. She watched the institutions that were supposed to be safe, banks, mortgage companies, brokerage firms, fail in sequence. She watched adults who had done everything correctly lose their homes, their retirement accounts, and their jobs in the same 18 months. The Dow fell from 14,164 in October 2007 to 6,469 in March 2009. She was 20 years old. The lesson her nervous system recorded was not markets recover over the long run. It was, the people who were supposed to warn you were profiting from your exposure. James watched the same crash at 34. He had a house with 7 years of equity. He had a decade of career capital at a stable employer. He had already survived the dot-com bust in 2001 and come out intact. His mental model absorbed 2008 as a severe but temporary correction, painful, survivable, and consistent with prior experience. For Maya, 2008 was not a correction. It was the first economic reality she ever knew. When she started building her financial life, she built it on a foundation of institutional skepticism that James found excessive. And that was the most calibrated possible response to the specific evidence she had received at the most formative financial age of her life. Now let's talk about student loans. James graduated from college in 1996. The average annual cost of a 4-year public university that year was approximately $3,700. His part-time retail job covered most of it. He graduated with $6,000 in total debt, paid it off in 18 months, and has not thought about it since. But here's what. Maya graduated from the same category of institution in 2010. Average annual cost, $14,800, a 300% increase in 14 years, outpacing both inflation and wage growth at every point along that curve. She graduated with $34,000 in student loan debt at rates between 5% and 7%. She entered a labor market that had shed 8.7 million jobs and was recovering them slowly, prioritizing experienced hires over new graduates. Her debt-to-income ratio at graduation was structurally different from James's. She was not less responsible for taking the loans. She was following the same social contract that had worked for his generation. Earn the credential, gain access to the career path, earn more over time. The terms of that contract had changed. The cost of the credential had tripled. Nobody updated the contract. For James, student loan debt primarily reflects poor financial planning at 18. For Maya, it reflects the only available path into the credential economy. Priced by a system she had no leverage over at 18, and paid for during the first decade of earning that should have been building wealth instead. Here's the thing. Maya does not resent the debt. She resents that the debt was the price of following the rules correctly. Now let's talk about housing. Maya knows the advice. Buy a house. Stop renting. Build equity. Start compounding a real asset. She has heard it from James, from her parents' friends, from every financial outlet that has ever addressed millennials directly. And here's the part James does not fully process. Maya has run these numbers repeatedly with a spreadsheet. In 2024, the median home price in the United States is approximately $417,000. The median household income for a millennial is approximately $73,000. Price to income ratio, 5.7. When James bought his first home in 2001, that ratio was 3.2. To save a 20% down payment on the median home today, Maya needs $83,400. At her current savings rate, after rent, student loan payments, and monthly expenses in a mid-cost city, that takes 7 to 9 years of focused accumulation, assuming prices stay flat. In the last 10 years, median U.S. home prices have increased approximately 87%. They have not been flat in her adult lifetime. James's advice is not wrong in principle. Home ownership builds equity. It forces savings discipline. But here's what. The math of executing that advice today is categorically different from the math of executing it in 2001. James built significant net worth by stepping into a housing market affordable relative to incomes at the beginning of a 20-year rate decline that made each refinance a compounding wealth event. Delivering that advice from that position applies sound logic to inputs that no longer exist. Maya is not avoiding homeownership because she values flexibility over stability. She is running the numbers and arriving at a different entry point than James reached in 2001. Because the numbers are different. And here's the part that explains the income behavior. The loyalty contract. James has worked for the same employer for 21 years. He receives annual raises averaging 3% to 4%. His defined benefit pension will pay approximately 60% of his final salary in retirement, guaranteed and market independent. His financial plan assumes a single primary income source, compounding steadily through his late 60s. Maya has had 6 employers in 14 years. She earns freelance income on the side, between $1,200 and $2,800 per month, depending on the quarter. She has 3 active income streams, tracks her net worth monthly in a spreadsheet, and has separate emergency reserves for each income source. James reads the job switching and side work as instability. Maya sees his single employer reliance as concentration risk. But here's what. They are describing the same economic reality through completely different risk frameworks. James's framework was built in a labor market that rewarded loyalty. Stay, accumulate seniority, receive the pension. Maya's framework was built in a labor market where loyalty to a single employer consistently produced 2% to 3% annual raises, while switching produced 12% to 18% salary jumps per move. The research on this is consistent across the 2000s and 10s. Job changers outpaced job stayers by 10 to 20 percentage points per transition. Maya is not diversifying income streams out of anxiety. She is diversifying because the single-source model stopped delivering on the promise, and the math confirmed it. The gig economy did not create millennial hustle culture. The gig economy is that culture made visible. Millennials were already diversifying income before the platforms existed, because the loyalty contract James's financial model still depends on had been quietly renegotiated without their consent. And here's the part that explains the savings behavior: retirement. James's retirement plan sits on 3 floors. His pension provides a guaranteed monthly payment regardless of market conditions. His Social Security benefit will cover approximately 40% of his pre-retirement income. His employer matched his 401k contributions for over 2 decades. 3 floors, stacked, mostly funded by others. Maya's retirement plan has 1 floor. A 401k she manages herself. No pension. Social Security appears in her projections as a supplemental line item. The Social Security Board of Trustees own report projects trust fund depletion by 2033, with continuing income covering roughly 77% of scheduled benefits absent legislative changes. Her first two employers did not offer a 401k match. She started contributing to tax-advantaged retirement accounts 3 years after James started his, which at a 10% average annual return represents approximately $22,000 in compounded growth she never had access to at the start. Here's the thing. Maya does not have a retirement anxiety problem. She has a structural underfunding problem, created by entering the workforce at the wrong moment with the wrong employer circumstances, inside a retirement system that had already shifted its funding risk from corporations to individuals before she arrived. She maxes her Roth IRA every year. She contributes 12% of gross income to her 401k. She uses her HSA as a secondary retirement vehicle. She is doing the maximum available to her inside the current system. James thinks she should be saving more. She is saving everything the system will allow at the maximum tax-advantaged rate, from a starting point that arrived 3 years late. So what should James actually understand about Maya's money habits? 3 things, and none of them are what he's currently offering her. First, the due diligence. Maya researches every major financial decision in a way that James finds exhausting and she finds basic. Before she opened her brokerage account, she compared 8 platforms on fee structures, tax loss harvesting capability, and SIPC coverage. Before she increased her HSA contribution, she read the IRS guidance and 3 independent analyses of the triple tax advantage. She tracks her portfolio's blended expense ratio to the 3rd decimal place. Here's the thing, this is not neurotic. It is the behavior of someone who learned at 20 that trusting institutions without verifying them produces loss, and who watched that lesson play out on a national scale during the most formative financial years of her life. James trusts his financial advisor because the financial advisor has always been trustworthy within his experience. Maya's generation watched trusted advisors and major institutions contribute directly to the 2008 collapse while their clients bore the cost. The skepticism is not inherited neurosis. It is updated priors built on observable history. Second, the index funds. Maya puts 100% of her equity allocation into low-cost total market index funds at a blended expense ratio of 0.04%. She does not pick individual stocks. She does not pay an active manager. She does not rotate sectors based on market commentary. James thinks this approach is passive to the point of lost opportunity. Maya thinks paying 1.2% in active management fees to underperform the benchmark 87% of the time is the actual definition of lost opportunity. The data sides with Maya. The SPIVA scorecard published annually by S&P Global consistently shows that over any 15-year horizon, 87% to 93% of actively managed large-cap funds underperform the S&P 500 index net of fees. Maya found index funds not through a marketing campaign. She found them through the same research process she applies to every financial decision. And they were the conclusion the data pointed toward. James's active manager beat the index last year. Maya's index outperformed 87% of active managers over 15 years. They are both describing real experience. One of them has a larger sample size. Third, the timeline. Maya's major financial milestones are running 7 to 10 years behind where James was at the same age. He bought his first home at 27. She is renting at 37. He was fully vested in his pension at 35. She has no pension. His retirement account balance at 40 was approximately $140,000. Hers at 37 is $87,000. James reads this as a discipline gap. But here's the part that reframes everything. Maya's net savings rate as a percentage of gross income is 15.3%, nearly identical to James's at the same age. The same discipline. The same percentage of every paycheck directed toward the future. Inserted into a cost structure featuring higher rent, a $34,000 student loan at entry, a higher housing price-to-income ratio, and a lower inflation-adjusted starting wage, the same savings rate produces a smaller balance at the same point in time. The gap in outcomes is not a gap in behavior. It is a gap in the cost structure those behaviors are operating inside. James thinks Maya needs to try harder. Maya is trying at the same rate inside a harder set of inputs. And the math shows exactly that. Maya is not financially irresponsible. She is financially shaped by a crash at 20 that taught her institutions fail without warning, by debt she accumulated to follow rules that had already changed, by a housing market that moved the entry point, and by a labor market that rewarded mobility and called it instability. James is not out of touch. He is describing behaviors and timelines that worked inside an economy that produced genuinely different inputs at every stage of his financial life. The advice he gives Maya is accurate for 2001. Maya is building her financial life in 2024. The inputs are different. The math is different. The rational responses to those inputs look different too. Understanding where her habits came from doesn't mean she's doing it wrong. It means knowing which parts of her story are yours. This is what we do at Vaulted Finance. The kind of money math that doesn't make the headlines but quietly decides how the next 30 years of your life actually play out. New breakdowns drop here regularly, so subscribe if you don't want to miss the next one. And drop the topic you want us to break down next in the comments. We're reading, and the most requested ones are the ones we cover first.